So students, welcome back. Now, as you've already seen, why are we even assessing these risks, right? How is it helpful for the audit? We have seen that. But now we have to check into the details of it. What is audit risk? What are its components, right? So let's get into it. See, audit risk is the risk that the auditor provides an incorrect opinion on the financial statements when they are materially misstated, which means that when the financial statements are misstated, auditor gives an opinion against it, like they are not materially misstated, right? So we will see how these happens, but let's get into this thing. What is this materiality? Let's see it in detail. Yes. Yes. So, an information is material if omitting it, misstating it, or obscuring it could individually or in the aggregate reasonably be expected to influence decisions that the primary users of financial reports. What did you understand from that? See, there are users who use the financial statements of the client company or the company and make decisions, economic decisions, like should we invest in that company or should we give loan to that company, like that. So they're making some decision on the basis of the financial reports or financial statements. Who prepares these financial statements? The directors of the company, correct? So we are telling that something or some transactions or some items are material if that item is omitted, which means that it is not included, then the user's decisions will change. If it is misstated or it has some errors, the user's decisions will change. Or obscuring it, which means that hiding it by either keeping it as a low priority item when, see, let's say for example, there is a contingent liability and the company is disclosing it of 500 crores. Now, this 500 crores is mentioned in small letters, which means that small font, right? So the investors might not or the users might not really see it. So that means the management wanted to obscure it or hide it, correct? So obscuring it may lead to a different decisions by the user. So something which affects the decision of the user and influence the decision of the user is called a material information, right? So materiality is subjective and should align with the client circumstances. Subjective means it depends upon person to person, it changes, correct? So the thing which is material for me might not be material for you. If the financial statements contain material misstatements, which means that there are misstatements which will affect the decisions of the users, then they cannot represent a true and fair view. Now, this true and fair view is what we will consider or we will refer to when saying that the financial statements are properly prepared. Now, till now, we have used the terms properly prepared, but now on, we'll use the term the financial statements represents a true and fair view. So, if the financial statements contain material misstatements, they cannot represent a true and fair view. So, let's go back to the audit risk. Let's look into the opinions. See, the auditor may give an opinion that, okay, the financial statements give a true and fair view or the financial statements do not give a true and fair view. Correct. So, the risk is that, the audit risk is that the auditor may give an incorrect opinion. When the financial statements give a true and fair view and the auditor gives an opinion that it does not give a true and fair view, that is the risk. So, the audit risk consists of some factors which is affected by or which is dependent on the entity and some things that depend upon the auditor. So now let's discuss about something. If, let's say for example, our company is in a country where there is a change in law happening or they are going to expand the business into more locations. So such situations comes with many uncertainties, correct? So many uncertainties means the financial statements will also be affected with those uncertainties. Correct. So such expansions, or let's say the company has multiple transactions, cash transactions and everything, right? So a huge number of transactions may come with its own inherent risk that the company might have failed to report it correctly, right? So for now, these all depends upon the company. Now the company will have these risks because that might impact the overall financial statements. Inherent risk usually affects the whole financial statements instead of a single account balance. Correct. So such things happen. Correct. Now, the next thing what the company or the client company can do is that put some controls over it. So yes, the company will put controls at place. Like let's say changes in laws. They will train the employees and train the staff to learn the new laws and new standards. Correct. So that is how the controls are set at place. Now, even after that, there is a risk that if the controls are not properly working, not prevent from the inherent risk, then that is the control risk. Now, control risk arises when there are controls at place, but it is not really working properly. Correct. So, the examples would be even after the training, we don't know if the staff is experienced, and the resignation of key staff. Like say for example, our financial manager resigned. Now there is no one person who authorizes the new laws and new changes in the financial statements. So if there is no authorizer, then there is a chance that the reliability on the financial statements is very low now. So till now we have discussed only the management side or the company side. So if the controls are set at place, but the controls are very weak, then the control risk is very high. Now, these both inherent risk and control risk affects the financial statements, correct? You agree with me that the inherent risk which comes with a change in transactions or change in the laws, standards and business, right? That will affect the financial statements. If the controls are set at place but very weak controls, that means that the financial statements may be misstated. So these inherent risk and control risk is collectively known as risk of material misstatement. The risk of material misstatement is the responsibility of the management. So the management's duty is to see the inherent risk that comes along with the new changes and implement controls. Correct. So let's just discuss how this impacts the auditor. Now, if the control risk is very high, that means the controls are very weak. That means auditor has to test more. He has to perform so many procedures to form his opinion. Correct, because there may be so many errors, so many misstatements, so many material misstatements in the financial statements because of the inherent and control risks. Correct. The inherent risk and control risk is very high. That means that the auditor has to perform so many procedures. And if something is challenging the auditor from doing so many procedures, that is where the detection risk comes. So, if the financial statements has some material misstatements and the auditor fails to identify those, then there is a risk that the auditor provides an incorrect opinion. Correct. So, you can link back to the audit risk definition. So, what does that mean? What does that mean? That means that even though there is a risk of material misstatement, whatever the auditor can do is to reduce the detection risk. Correct. He has to detect all the material misstatements, then he can form the correct opinion. Correct. So let's see in detail about the detection risk. Detection risk, some examples would be inadequate planning, limited resources, which means that there is limited time or limited humans to perform some procedures. Like say, we are going to count the inventories at a warehouse and we have only 2 members. There are 5 warehouses at different locations and these go over every location and count the inventory. So there is a chance that the count of the inventory is not really confirmed and there will be chances of risk of material misstatements, or there is a chance of material misstatements being not detected by the auditor. Correct. Here, let's see in detection risk, there are 2 risks, sampling risk and non-sampling risk. Sampling risk means that we took the wrong sample. Now the sample which has, let's say for example, there are 10 receivables and we took 5 of them. The other 5 might have got too many material misstatements, but we took the 5 which has lesser number of material misstatements or no material misstatements at all. So that will affect our opinion to go wrong, because we will say that the financial statements give a true and fair view. This has no material misstatements. But if you took that sample, you would have made an opinion that the financial statements do not represent a true and fair view. So that is the risk. You understand? Now, non-sampling risk is that auditors' limitation like experience, time constraints, the staff are very low or the time is very less. The management is telling us to complete the work in 1 week. That is a detection risk. So if you see here, audit risk equal to inherent risk into control risk into detection risk, and risk of material misstatement equal to inherent risk into control risk. These both, who are controlling these things? The management. What is in the control of the auditor? Detection risk. So to reduce the audit risk, what is to be reduced? The detection risk to be reduced. So if the control risk is too high and the controls are very weak, that means there are many material misstatements, so we have to increase the audit procedures we are doing, correct? So if we are doing many procedures, then the detection risk will go down. If we are doing lesser procedures, the detection risk will go up. To understand the point, right? So let's continue. Yes, I've also given you with an example of Infosys. You may read it and you will have a good understanding. So let's discuss the planning materiality and performance materiality. So we have seen what is materiality. So something that is important for the users when they make decisions, correct? Economic decisions, correct? So let's see what is this planning materiality and performance materiality. At the planning stage, company might fix a threshold that okay, if the company has let's say a revenue of 500 crores and they are fixing a materiality benchmark of 500,000. Whatever item that comes below this 500,000 benchmark will be immaterial, or we can ignore those and we will test on the above 500,000 items, right? Now, and this is set for the overall financial statements or financial statements as a whole. That means that any item below 500,000 we are not going to test, right? Because it is immaterial. Why are we even testing? It does not affect our opinion because we are giving an opinion on the basis of material statements, correct? There is a chance that there are items like 200,000, 100,000, 100,000, 100,000. Like these, there are some misstatements hidden in the individual items, like let's say for example in SOFP there are some misstatements in the bank loan of 300,000, and in the current assets, let's say in the cash, there is a little misstatement of 100,000. See, these items together constitutes a material amount, or are it surpasses the 500,000 threshold. Right? The auditor should not make an incorrect opinion on the financial statements. For that matter, there is performance materiality, which means that after the planning stage, we have already fixed the threshold of 500,000. But now we are going to set another threshold, which means that, let's say, for example, we'll take 200,000 as the new threshold. Now, whichever item which comes above 200,000, we will see if the misstatements collectively constitutes to a materiality level, or collectively go above the materiality threshold of our 500,000. So that will ensure that the auditor's risk of giving an incorrect opinion is reduced, right? So performance materiality controls the risk of combined misstatements exceeding materiality, targets the likelihood of undetected aggregated misstatements, acts as a lower threshold during audit procedures, which means that we have set a 200,000 threshold, correct? So that is lower than the 500,000. So that is meant by the lower threshold. Now might require revision based on the audit progress or new information. Let's take the example of amounts which are, or transactions which are higher than the 500,000. That is called material by size. So there are some benchmarks which we are going to learn, and these things we have to by heart. Okay, but it's easy to learn. Any transaction which is more than half percentage of the revenue is material. That is meant by this. This benchmark represent threshold, a threshold where anything below it is immaterial and anything above it is material. Okay, so another example of material by size is not percentages, but if the materiality is set at 3000, then anything above 3000 is material. So a sale of printer at a company amounted to 4000 is material if the materiality is set to be 3000. If the materiality was said to be 5000, then this 4000 is below it, right? So we can ignore it. So that is the main definition of materiality, correct? So something below, then it is not material. But regardless of the amount, there are some things which are material by nature. Certain items may be material due to their nature, like compliance with the regulations or debt covenances. So, if the company fails to comply with such things, then it is material regardless of if it is $2,000 or $5,000, right? So, next one would be adjustment turning reported profit into a loss or net assets into a net liability, which means, for example, our revenue was $2,000 and our expenses accounted to, let's say, 1,000, and right, and our reported profit was $1,000. And now we had an adjustment to be made to the statement of profit or loss of expense of 1,500. Then let's see, the profit now is 1,000, and this expense, if we adjust it, now the company has a loss of how much? Loss of $500, correct? So such adjustments will be material by nature, right? So that is there. Now, director related transactions, that means related party transactions. So we have to mention the disclosures correctly. We have to give disclosures correctly when in the case of related party or even going concern. So if you have not given, even if it is $1, we have to disclose it. If we have not disclosed this, that is material by nature, correct? So that is all about materiality.